There's so much to talk about today. We're going to try and get to all of it, but we're going to start off with the slow clap to the Congressional Budget Office. And that sounds really boring, I know. It's absolutely not that. Wait till we get to that. And also in this video, we also have to touch on a few things. I want to show you in the headlines of the news, interpret them for you. We have to talk about a true black swan event, a really unique thing that just happened on one of the charts of one of the gold mining stocks that we follow. We're going to talk about the gold to silver ratio, speaking of which, and a bunch of other financial headlines that just happened. Iran's President Raisi is dead. That just happened, the helicopter crash that you've heard about. I wanted to call out this article because it's a perfect example of a black swan event. So many people have a misunderstanding what a black swan event actually is. They'll talk about, well, maybe this could be a black swan event. What about the debt, for example? It's not a black swan because it's not surprising anybody. The helicopter crash, which is going to actually set off a lot of ripple effects all over the Middle East and the whole world, had a big impact, and it was unexpected. It was a total, true black swan event. Good example of that. And I promise you, I'd tell you what we did on Thursday. Thursday, we released the selection at $1.01 of Sphere 3D, and they're already over $1.50. That was Thursday. Fed Governor Waller wants several months of good inflation data before lowering rates. I would encourage you to put all of this out of your mind. There's always different opinions. They keep saying things, trying to lead you this way, lead you that way. Ignore all of it. Put it all out of your mind. Just know the eventual end result that there will be lower rates. They will lower rates either this month or 3 months from now. But you know that rates are coming down, and a lot of times when everyone widely knows something, they position ahead of time to try and make good decisions, good profits. So if you're all expecting the rates to come down, and a lot of people think that means that gold prices will go higher and the dollar's value will come down, then people act on that ahead of time. So rates are going to come down. That makes gold prices go higher. I should invest in gold. But the thing is, the people who make the most money from it are the ones that get involved way ahead of the game, who are upstream, like you guys. You should already be invested in some of these gold mining companies. If you're not, it's not too late for a few of them. And there's plenty of new opportunities, just like what happened on Thursday I told you about. And in the last video I did talking about opportunities, what's going to show up and how to take advantage of them. There's always good opportunities in whatever environment or market or situation you are in. You can always turn a few $100s into a few thousand relatively easily. That's what I'm helping some of you do. And I want to talk about the 1 month Newmont chart, Newmont mining. I want to show you something. Here is where we're talking about how prices of gold and precious metals were higher. And so then when they reported their financials, then the results of those higher prices would factor into their earnings, into their revenues. And it did exactly what I told you it was going to do about a month ahead of time. And then look what happened though. This is very curious, very rare, very interesting. Every single day's trading after that was within the range of the big up day when they got the new financial reality. So all the trading happened between the low of that day and the high of that day, and certainly among the intraday low and high of the day, until 2 days ago and yesterday. And it's down a little bit today, but that means something. If it broke out of that new range, this could be the new floor. That's what often happens when a chart sets up like this. The slow clap goes to the Congressional Budget Office. Not as boring as it sounds. Listen to this. You guys already knew. How long have we been talking about all of this? And they're finally figuring it out. And you already all knew about this. And now they're acting like, oh, what a surprise. We saw the problem for the first time. It's been a long time since any major media has noticed any of this commotion and these problems that I've been telling you guys about for so long. So I'm so glad to see this article. But check this out. CNBC. Soaring debt and deficits causing worry about threats to the economy and markets. The federal IOU is now at $34.5 trillion, or about $11 trillion higher than where it stood in March 2020. Chatter has spilled into government and finance heavyweights, and has one prominent Wall Street firm wondering if costs associated with the debt pose a risk to the stock market rally. I'd say that it poses more than a risk to the stock market rally. It poses a risk to our entire quality of life, this entire economy. And now that they're finally seeing what I've been telling them was coming for so long, now people are going to realize that they say the first thing to deal with the problem is to identify that you have a problem. So now we're at that phase. But the problem is, it could have been fixed a couple of decades ago by draconian measures and all the stuff that I'm talking about that we should do now. Even if we do it now, it won't really get us out of this predicament. You'll see what I mean as more and more people start recognizing this and then saying, okay, what are we going to do about it? Too late. Sorry, folks. The CBO estimates, that's the Congressional Budget Office, that debt held in the public compared to GDP will rise to, quote, an amount greater than any point in the nation's history. Stop right there. I got to pause right there. Of course, they say that. It's always going to be, a minute from now, the debt will be greater. A week from now, greater. And they're talking about, oh, it could get to the point where it would be the greatest it's ever been. Well, at that point it will be. And the next day, it'll be the greatest it's ever been. And the next day, the greatest it's ever been. It just grows. What's the point of that comment? Who's paying these guys for their expert analysis? Fed Chair Jerome Powell said recently that this is something that elected people need to get their arms around sooner rather than later. That is called sidestepping the blame, shifting the blame, pointing the finger. That is insane. He's saying that politicians need to, what? Tell him to not make all these mistakes? It's their fault? Because they have to get their arms around this sooner rather than later because it's a big problem. And what, you did nothing about it this whole time? Jerome Powell, you're letting everybody down. Here's some charts from the article. Total U.S. debt held by public as a percentage of GDP. These charts are pretty self-explanatory. This one is U.S. total deficit as a percentage of GDP. And finally, we're going to end it with total U.S. deficit. Now take a look at 2020 and 2021. Back in the days of Peloton and social distancing and border closures, there was a lot of stimulus payments that went out, exacerbating the insane inflation that we're going to be facing coming up. As their customers age, Macy's, Kohl's, and Nordstrom are chasing younger shoppers. I just wanted to include that because I just don't care much for that phrasing. This is from mining.com. The average gold to silver price ratio during the 20th century was 47. Over the past 20 years, the ratio has averaged around 60. I've told you guys that very long term, the ratio is actually lower than that. It's more like 45 to 50. But people say it wrong. They say it's the gold to silver ratio, but really you're comparing silver to gold. How many ounces of silver does it take to buy 1 ounce of gold? It was as high as 88 recently. You'll see in this chart that it's actually come down to 75, a little bit more sustainable maybe, but it's still going to always come down. And you're seeing that silver prices are rising more on a percentage basis than gold, and that's helping the silver to gold ratio. I don't want to confuse you, so I'll call it the gold to silver ratio. It helps it normalize. Silver will always outperform gold on a percentage basis on average over time until the silver to gold ratio is more like 50. The ratio is most useful at its extremes. When the ratio topped 80, it has signaled a time when silver was relatively inexpensive relative to gold. Silver went on to rally 40%, 300%, and 400% the last 3 times this happened. And the rally this time will be a lot more than target lowering prices on 5,000 frequently bought items. The company said in a statement that the price cuts are concentrated in grocery staples like milk, meat, bread, fruit, and vegetables, as well as paper towels and diapers. It had already cut prices on some 1,500 other items. That's just a great example of some more anti-inflationary or deflationary forces. As inflation fell, the price that you're paying for groceries was still higher, and everybody saw that. And now it's finally starting to come down, not just with what Target's doing, but overall, grocery inflation has started to be coming down enough that you'll start noticing it. I want to clarify something I said before. I always tell you I pinpoint invest rather than diversify. I don't like to diversify because then you get a bit of what everybody else is getting. I look for what I think is going to be the best investment, and then I focus on that. So I bought gold, but I didn't just buy one gold stock or two gold stocks. I bought a whole bunch. I diversified within the concept. Same with, I think that oil and gas is going to do well. I diversify within that concept, but I don't diversify just buying a little bit of everything. Red Lobster filed Chapter 11 bankruptcy. It just reminded me, it's just another in the long line. I'm not going to try and make a big list of all these companies that are going bankrupt. There's a lot of them. There's a lot of financial hardships right now. I told you about the default deluge and the tsunami of delinquencies right now, even on people's auto loans. There's a lot of delinquencies there. But this article reminded me to tell you a warning about bankrupt shares, because even after bankruptcy, the shares will still trade for weeks or months. And people say, well, GM went bankrupt and there's still GM cars around. People are always going to be buying cars. So obviously GM is worth a lot and it's trading at bankruptcy level, so they're trading at pennies a share. So you think you're a good investor by buying those shares, but you're not buying into GM shares. You're buying the old shares. There's no angle here to make money from this. A lot of people get burned. You could get lucky, I'm sure. You can make a few bucks, but almost certainly not. You're buying the old company shares, not the new company shares. They've made a new batch of shares that's what the new GM stock is. So if you go and buy a bankrupt company like Red Lobster, there is no out. These shares will eventually become worthless. Did you guys know that you could get direct contact with me by email, ask me anything you want, and also get the Peter Leeds Insider exclusive newsletter, which comes out once a month, where I talk about whatever I want to talk about? You can get all that for as low as $3 a month if you become a Peter Leeds Insider. Just go to peterleeds.com/insiders and you can join up today.